All right. Hi, everybody. We're getting ready to start here. We're expecting a few more folks, so I'm just going to wait just a couple of minutes. I want to respect your time, those of you who were here right at 11:30, and then we'll get started. So give us just a couple minutes. Okay, so let's go ahead and get started. Thank you, everybody, for being here. Today's webinar is called Strategic Asset Allocation, Maximizing Returns and Minimizing Risk. And I'll just start us off by saying that this is by far the most important part of the work that we do in portfolios. So last or the last webinar on risk and return might have been a little basic and not as heavy in content, but today's webinar is going to go a lot deeper. And this is a topic that I'm super passionate about because it makes such a difference in people's investment experience. So really excited to share with you. We will, as part of our agenda, have a Q&A session at the end. So as we're going through the content, if you have any questions, if you can just make a note of those and hold them until the end, and then I will be sure to get to all of those questions. So our agenda for today is first to talk about what is asset allocation? What do I mean when I talk about that? And then secondly, why does it matter? So if we invest your portfolio in a certain allocation, does it really matter? And then third, we're going to talk just a little bit about modern portfolio theory. That's an area where I can get really into the weeds, and I don't want to do that. So hopefully I can give you just a really helpful overview of how we construct portfolios using modern portfolio theory. And then fourth and fifth are the two biggest areas where I see people making mistakes as they're making their own investment decisions. So the first one is timing the market, and the second one is stock picking. So these are two areas where I think it sounds attractive and conceptually people feel like they can do it, but in reality, it's not it's not something that's sustainable, at least not over a long time horizon. And then, as I mentioned, finally, we'll have Q&A at the end. Okay, so to start us off, I came up with a question, and I'm going to put this into a poll. If I can figure out, this is my first time. Nope. Let me go back. Sorry. I didn't, I assume I'm showing my notes now, which is, there we go. Put us back. And then we're going to go to polls. Okay, here we go. So the first question I'm going to pop up on your screen. And if you would be so kind as to put in your answers. So the question is, which of these drive portfolio performance the most? So is it individual fund or security selection? Is it market timing? Is it asset allocation? Or does Warren Buffett drive these things? So please put in your answers to the poll. I'll give you a few seconds to do that. Okay, there. I think I've launched it. Okay, we have a couple of answers, just waiting for a few more. Okay, so I'm going to go ahead and share the results. Looks like 25% of the responses were for individual security or individual fund or security selection. 25% was for market timing, and then 50% was for asset allocation. So let's go to the actual correct answer, which is asset allocation. So it's a really common misconception that choosing the specific fund or stock or bond makes the most difference. But in reality, if you can get the asset allocation right, that actually will contribute to 95% of your result. So it's very important that we get the asset allocation right. Okay, so let's talk a bit now about what is asset allocation. What do we mean about that? So, asset allocation is dividing your investments among different assets, such as stocks, bonds, and cash. So, we do this at what we call a big picture level. And then we also have a more detailed asset allocation within the stocks and within the bonds. So asset allocation is very personal. So just because someone you know has a certain asset allocation, that definitely does not mean that it's the appropriate asset allocation for you. And then the other thing to note is that asset allocation can change during your life. Now, when I say that it can change, that's not in response to anything that's going on in the market, the world, or the economy. It would actually just be changes that relate to your personal situation. So, the most common one of those would be when you hit retirement. Typically, your asset allocation would be adjusted to be a little bit less in equities, which would be a little bit less volatile since you're no longer earning income and you are planning to live the rest of your life off the assets that you've saved up to that point. Okay, so this is the big picture allocation I was speaking of. This is a sample from some of the clients we have that are 70% in stocks, and then between bonds and cash, that makes up the other 30%. Each person's cash need is a little bit different. It depends on whether or not you're taking distributions from your portfolio or if you're still working and saving. So just we add these together to get the other percentage of 30. And so we would call this a 70-30 portfolio. So if you ever hear me talking about, oh, you have a 60-40, you have a 70-30, this is what I'm referencing, percentage of stocks to bonds and cash. And then this little chart is our detailed allocation. And those of you who are clients may recognize this from your investment strategy. And it is also stocks, which are all the colorful sections, and then bonds, which is the gray section, and cash, which is the white section. But you can see we've broken the equities out. And equities, just so you know, is the same as stocks. So equities are stocks, and bonds are the same as fixed income. So those terms are just pretty interchangeable. But the stocks are broken out here between US large cap, both growth and value, and then the same for US small cap, growth and value. And then the three shades of blue are the international. So we have international large companies, international small companies, and then emerging markets, which is undeveloped countries or what we would call developing countries. And then the purple is real estate, and then back to cash. So that when we talk about asset allocation, these are just a handful of the reasons why it matters. So first of all, it provides diversification from your portfolio. So that means holding different types of investments in different percentages to create an overall result. It also reduces correlation. So when we talk about correlations, what I mean is that how one asset class behaves in relation to a different asset class. So, by way of example, stocks and bonds at the very big picture level don't typically move in tandem with each other. So, they don't go like this. They might, if stocks are going down, bonds might be a little down or even up or stay steady, but there is not what we would call a one-to-one correlation. So when you have a lot of different things, then you end up with a lot more different correlations, and that helps to protect you against a severe market decline. Third, it minimizes risk. So when you have diversification, it reduces the overall volatility in your portfolio, which is just the ups and downs over time. So when we can have a really diversified portfolio, then instead of going up, down like this, you're going to have a much more smooth up and down chart. Next, higher expected returns. So when we can remove those lower downs, even though the highs won't be as high, that produces an overall higher return over time. So that's what we're all looking for, the maximized return given a certain level of risk. Next, it provides flexibility. So it allows for investments that cater to both your short-term and your long-term goals. So some of these asset classes, if I go back to this slide, for example, the international asset classes, particularly emerging markets, those are more volatile, but they also produce a higher return. That's why we have it as a minority of the portfolio and not as large as, for example, the US large cap or the bonds. And so the bonds are more of a like shorter term investment. The emerging markets on the other end of the spectrum are more of a longer term investment or would be better for a longer term goal. And so having a diversified portfolio allows us to bring in both of those goals in one portfolio that's going to suit you over the long term. Next, it provides a better investment experience. So if the lows are not as low, obviously that's less stressful when the market's down. So if the market's down, let's say the S&P 500, which is the index that measures the 500 largest US stocks, and back to our chart, that's going to be the red and orange together. So when the red and orange are down, let's say 40%, but your portfolio is only down 25 or 30%, that's just going to be less stressful for you. Next is it reduces emotional bias. So when the market is doing what it does, which is go up and more importantly to your emotions goes down, having a diversified portfolio that doesn't bounce around as much helps you to stick with your strategy and avoid making a fearful decision in a market downturn or an exuberant decision when the market's just going up like crazy to buy things at the top. So it just really helps you to handle your investments with less emotion, which means more logic, and then that produces a higher result at the end of the day. And then the last one I have listed here, although this is not a comprehensive list by any means, is customization to goals and risk. And so your allocation is customized for you personally, your risk tolerance, your goals. What are you trying to accomplish? And then by just tweaking the percentages in the pie, we can get to an asset allocation that is really very well suited to your individual situation. Okay, and so this slide is showing the benefits of diversification. And the data goes through 2022 from 2008. And I believe this slide came from Dimensional Funds, which is our mutual fund company. And I believe the reason they chose 2008 is because that is the beginning of the last very significant market downturn. So this would include what they call the financial crisis of 2008, 2009. And so the the MSCI All Country World Index, which is basically the global stock index, includes all companies in all countries that are in any index. The return over that period was 5.4. But if you missed just the top 10 performers each year, that brought your return down to just a 0.5%. So you gave up almost 5% over a, what is that, 22, 12, 14-year period. And then if you excluded the top 25 performers, whoops, your return, can't see the bottom of my slide, sorry. Let me see. Anyway, you can see it's grossly negative. So the bottom line here is that research shows there's no reliable way to predict the top performers, and broad diversification helps reduce any unnecessary idiosyncratic risk. Okay, so now I have another poll question for you. So this question is, which asset class performed the best last year in 2023? Was it US small companies, US large companies, international, or real estate? And I will go ahead and launch that poll and then just go ahead and click on your answer, and I'll give you a few seconds to respond with your best guess. All right, we have a couple answers. I'm just waiting for a couple more, and then we'll look at the results. If you don't know, just give your best guess. Okay. All right, so this time we were evenly split a third, a third, a third between US small cap, US large cap, and international. So the correct answer is US large cap. So that would be the S&P 500 in terms of the actual index that performed the best in 2023. But this chart shows you how much that changes from year to year. So at the bottom is the key, but basically the blue shades are the US stock indexes, either large or small, or the dark blue is real estate. And then the two colors that are like gold, brown, whatever, those are your international. And then the three shades of green are different types of bonds, 1 year treasury, 1 to 5, and then the government bond index, 1 to 5 years. So what we can see is in 2023, the S&P 500 was highest, which is US large cap, followed by US small cap, and then real estate, and then US, or sorry, international small, international large, and then we get into the bond funds. But the year before, it's interesting. Look, the different bond indices are at the top, and guess what's at the bottom? REITs, and then the US small cap, and then the US large cap is right in the middle. But just by eyeballing this whole chart, which goes back to 2009, you can see that it's pretty much a random pattern. In general, the greens tend to be closer to the bottom, which is what we would expect because bonds don't produce as high returns as stocks. But apart from that, it's kind of it's very random. So the takeaway from this is just that you can't accurately predict which area of the market you should be in next year. And so it's better to have just a well-diversified portfolio than to try to predict where to be in the next period of time. So that brings us to modern portfolio theory. And this is just a theory that allows investors to build a portfolio based on an algorithm, a mathematical model that maximizes the return for any level of risk along the risk horizon. So the assumption is that investors are risk averse, which means that if you are going to take any risk, you want to be compensated for that. So all things given being equal, like if the returns are equal, you're going to choose the less risky portfolio, which is logical. And so this chart over here is what we call the efficient frontier. And the portfolios that are along this frontier are the most efficient. So whenever we're putting together a portfolio for one of our clients, we're pitting it against this efficient frontier and trying to get as close as possible. Now, we can't get 100% on it because the portfolios that are part of the efficient frontier are theoretical. And when you actually invest, you have investment costs that brings you a little bit below the efficient frontier in terms of return. But aside from having expenses that are just a part of investing, we want to get you as close to this efficient frontier as possible. So these are the actual formulas that are involved depending on how many assets in your portfolio. So if you only had 3 asset classes, let's call them stocks, bonds, and cash, this is the formula for the algorithm that helps us to figure out how much of each of those asset classes should be included. But when we looked at our detailed asset allocation, there's a whole lot more than 3. And so that you can imagine how complex this formula actually gets when you include 8 or 9 asset classes. And so that's why we have software that helps us for this. And then Dimensional Fund helps us also because they produce their portfolio models for us that have already been put through this to be optimized as much as possible. So the way modern portfolio theory works is that for every asset class, we know 3 things. We know its historical rate of return, we know how volatile it's been in the past, and then we know how it correlates to other asset classes. So how it moves up or down when each other asset class moves up or down. And so the formula just optimizes the mix of assets in the asset classes for any given level of risk. So we start with your risk, and then we figure out what's the optimal portfolio for that's going to give us the highest return at that level of risk. Okay, and then that enables us to create models. And so we have different models for different levels of risk, and each model is assigned a risk score. Those of you who are clients know that we use a software called Nitrogen. It used to be called Riskalyze, and you take a fun little questionnaire, and then it tells you what your risk score is. And then we match that up with the model portfolio that makes the most sense in terms of being closest to your personal risk. And then the other side of that is when we do your financial plan, we need to make sure that that portfolio is actually going to be able to achieve your financial goals. And so sometimes there's a little bit of a mismatch between your personal risk tolerance and the portfolio that you would need to achieve your goals. And so that's where we would have conversations about, could you tolerate a little bit more risk, or do we need to dial back some of your goals? But we have to find a happy medium where the portfolio is going to be comfortable for you, but it's also going to achieve your goals. Okay, so then that leads us to the dimensional or DFA model portfolios. DFA stands for Dimensional Fund Advisors, and that's the name of the company. We typically refer to them as DFA, but these are their standard model portfolios. So on the left, going from 0% stocks with 100% in bonds, and then gradually going all the way up to the opposite, which is 100% in stocks, 0% in bonds. And then this just shows you the specific percentages that we would have in each category. But really what's important is to look down here. So the takeaways are that the annualized return ranges from a little over 5% to 10.5%, depending on the level of equities. And then the standard deviation likewise increases. So this portfolio here, the standard deviation, which is just a measure of, if you think of your traditional bell curve, and right in the middle is the average return, which is going to be this 5.18% on the 0 to 100 portfolio. And then if you go out two standard deviations like that, that's going to cover about 95% of the expected returns. And then the other 2.5% on the high end and the low end are what we would call out of the two standard deviation range. But within two standard deviations, this portfolio is going to move 2.56 for each standard deviation. So you would have to double that. So let's call it 5% plus or minus from this 5. So this portfolio would be expected to range roughly from 0 to 10%. And then likewise for this portfolio on the opposite end of the risk tolerance spectrum, let's just call this 10%, and then it could be 10 plus 2 times the 15, so 10 plus 30, positive 40%, or 10 minus 30, which is minus 20%. So minus 20 to plus 40 would be kind of the normal range for this portfolio. So our goal is always to find which of these is most comfortable for you. And just to show some historical data, I've provided the lowest 1-year return for each portfolio, which ranges from -6 all the way to -46. The lowest 3 years, so the 3-year annualized return for this portfolio is less than 1% negative, and this one is about 15% negative. And then the highest 1-year return for this portfolio, 18, but all the way up to almost 62% here. And the highest annualized return over 3 years would be 11 on the low end, 29 on the high end. And then finally, growth of $1. So if you had invested $1 in 1985 in this portfolio, what would it be worth today? So on the most conservative portfolio, that would be $7.16. And on the high end, it would be almost $50. So that shows you how being able to tolerate a higher volatility produces a higher return, but it also subjects you to some more bouncing around, as I call it, along the way, so it's less comfortable. And you may be asking or wondering why 1985 is the starting year here, and that really just has to do with the fact that all of these portfolios include emerging markets as an asset class, and emerging markets wasn't recognized as an asset class until 1985. So we aren't able to compare portfolios prior to that date that include emerging markets. So, all right, time for another question. Which developed country produced the highest returns in 2023? Was it China, the United States, Italy, or the United Kingdom? Let me, nope, this one, sorry. Launching that. So if you can just click on the answer that you think is correct. Give you a few more seconds on that. Okay, so again, we were split a third, a third, a third between China, Italy, and the UK. And what is the correct answer? Italy. So Italy was the highest. And again, I know this is a little bit small, but this chart shows the basic takeaway is to just look how varied and random the colors are across the chart. So this tile up here at the top is Italy, and this at the bottom actually is Hong Kong, and the US here is third. The UK is here. And China is actually was not a real answer because China is not a developed country. China is part of the emerging markets, so emerging countries. So again, the takeaway is that you can't predict which country is going to come out on top. You can see how varied these have been going back to 2004, and same at the bottom. There's just no pattern that you can really pick out. So there's no way, therefore, to predict the future. Whoops. E. Sorry. I think I just gave away the answer. Okay, sorry. Which emerging country produced the highest returns in 2023? And I'll launch that poll. If you were paying attention, you probably get it right. Okay, go ahead and put in your answers. Yep. Was it Hungary, China, Poland, my homeland? I'm 50% Polish, or India? Okay. So this time we had 1/3 to Hungary and 2/3 to India. And the actual correct answer is Hungary. So this is the chart for the emerging countries, and you can see Hungary is the hot pink color here at the top. And then at the bottom, we had China, which most people wouldn't have guessed for last year. India is here in the middle. And where's good old Poland? Oh, Poland was in second place. I bet nobody would have guessed that one either. Okay, so next let's talk about market timing. So market timing is the first of the two biggest mistakes that I see people trying to make in their investments when they're making their own decisions. So market timing is defined as the strategy of attempting to predict future market movements and making buy or sell decisions accordingly. So it's basically trying to guess what's going to happen accurately and then buying or selling in your portfolio accordingly. The cost of waiting for the perfect moment to invest, though, typically exceeds the benefit. Even if you time it perfectly, you've missed out during the time that you were waiting to make your move. And then statistically, in 9 out of the last 15 bear markets, going back all the way to 1929, investors who just stayed the course, meaning they stuck with their asset allocation and they didn't make changes during a down market, they made back their losses within 1 year. And in that 2008, 2009 financial crisis, which is the last really big market decline that lasted very long, the period of time that it took for people to get back to where they were was just a hair over 2 years, and so that was if you stuck with your plan for 2 years, you were back to where you started, and you didn't have to stress about trying to make the right decisions about when to get out, when to get back in. And what I see most often happen is that people jump out of the market when they're afraid about something. Like right now, it could be the election or just anything that comes up in the news that people get frightened and they can jump out of the market, which means you sell your investments and you move to cash, or you move to another popular one is gold, because it's widely being marketed as a safe investment. And then even if you got out at the right time, which is not likely, the next question is that when do you get back in? And that's where I see people who jumped out of the market and then they missed getting back in before it already went back up. And then when you get back in up here, you've missed out on all that appreciation on the recovery part. So, not a good idea. These are just a handful of the pitfalls that are associated with market timing. You can you have a high risk of mistakes, increased transaction costs because you're trading more often, the opportunity cost, like I mentioned, of missing out on that market recovery and on the compounding of returns. I'm not going to be speaking specifically to compounding of returns, but it really is an important part of investing. Is in the first year you get a return, and then in the second year you get a return plus a return on your return, and that's the compounding that you miss out on if you miss being in that first year. Increased stress. It's incredibly stressful to be trying to guess what's going to be going on in the market tomorrow. There's a performance lag, and this is the thing that's really hard to get your brain around, is that the market is very efficient, and anything that's already known is already priced into the market. But that also includes the hopes and fears of investors, because they've already been buying and selling based on what they think is going to happen. So that's those hopes or fears. And so that's already baked into the pricing. And so when you then think that you can time the market based on something, like, let's say you have a certain prediction about the election, and let's say that you think that if your prediction is true, that's going to have a certain effect on the stock market. And so you're trying to make trades now in anticipation of that. Well, unfortunately, the reality is that you're not the only one thinking that, and that other people are already buying and selling based on that, and that's already affected the price. And so you're not trading with any knowledge that's not already baked into the price, and so it becomes fruitless to try to do that. Next is behavioral pitfalls. Things that can come up is that you're overconfident, either about your abilities to pick stocks or about the stocks themselves. And there's what we call a recency bias, which just means things that recently happened in the stock market tend to have more of an impact on you. And it affects your decision making, and therefore you can make a poor decision because you're making it based off something that already happened and not that something that's going to happen in the future. It distracts you from your core strategies. So if we have you in a really nice, balanced, diversified portfolio, and then you decide to try to do some market timing, that will take you away from your core strategies. So especially if you're wrong, then that's really going to detract from your outcome. And there's a saying, even a blind squirrel can find a nut once in a while. And how that applies to this is that, yes, you might be able to time the market correctly from time to time, but to be able to do it consistently, accurately for like 20 years is really next to impossible. And then there's a long-term impact. So, like I said, when you deviate from your strategy, it really can compromise your financial goals, such as retirement. Okay, this chart is just showing that if you were in the market from 97 to 2023 and you invested $1,000 in 1997, you would have earned 10,550. And this is in the Russell 3000, which is basically the total world stock index. Excuse me. But if you missed the best week, your 10,550 would only be 8652. If you missed a whole month of the best days, you would be reduced to 8,279. If you missed 3 months, your profit would be reduced to 7,308. And if you miss 6 months, it goes down to 6728. So there's a real cost associated with being out of the market on those up days, but that's the natural consequence of being out of the market on any days that you think might be down days. And this slide is really just to show how our brains tend to work against us when it comes to investing. And these are some of the common thoughts that people might have, like the market tanked and I should have seen it coming, or I have a proven system for picking winning managers, or the trend looks good and should continue. Like all of these are really just guesses about what's going to happen in the future. Or hindsight, like this one, I knew this stock was going up, but now it's past the time that it went up. And so then you kick yourself, and then you might try to pick something the next time around. And so all of these thoughts do not lead to disciplined investing, which is where you're going to have the best experience. And this is what we call the emotional um, the emotional points that you go through or that you might go through. So it goes from being optimistic to being elated. And when we're up here at elation, this is when the stock market is soaring or there's a certain stock that's really going up. And you're saying, I should get into that because it's really a hot stock or the market's really hot. I should put more into it. But what you're doing here, you can see, is buying high. And then as the market corrects, which it always does, the market goes in cycles. Then you start feeling nervous, and then it goes to fear. And down here in fear is where a lot of people are really tempted to move some or all of their portfolio to cash or gold or something that they are less nervous about. But again, if you follow your emotions down here and you sell, you're selling low. So you bought high and then you're selling low. And that's the exact opposite of how you win in investing. You always want to buy low, sell high. And then the cycle goes back to optimism and then it just starts over again. So emotions are basically your worst enemy in investing. And this chart just shows like all of the biggest news events that you can think of that would have affected the stock market going back to 1970. So we have things like US inflation at 13.5%. We have Black Monday. We have the savings and loan crisis. We have this is what we call the financial crisis, the subprime mortgage crisis. We have the Iraq war. We have COVID. We have all these things. But if you look at the general trajectory, and this is the MSCI World Index. So again, it's basically US plus international stocks of all sizes. You can almost draw a straight line through this with very little deviation. Whoops. So the bottom line is there's always going to be all these salacious news headlines, and they're selling, news channels are selling headlines. They're not there to report what's really going on. And so they're going to make everything as bleak and scary and frightening as possible to get people to watch. But you can see that over time, the bottom line is the market is resilient. It's overcome all of these things. And even if we were to go further back, all the way back to the Great Depression, the market is resilient. And from 1926, that gives us 98 years of historical data that we can then look for trends and averages and those kind of things. So it gives us just a really high level of confidence in the market. And I guess the other point I would make is that when you're in one of these points, one of these scary things that's going on, let's pick 9/11. It's really what I hear commonly is this time it's different. And it is. Each time is different. But in all of these things, the market has not been different. I mean, maybe for a period of time, like here to here, or here to here, or this is COVID. Look what a small blip COVID is in the grand scheme of this. That's interesting as well. But anyway, yes, it's different, but the end result is highly unlikely to be any different than any of these other major events that have taken place. Okay, so another question, which of these items drive portfolio performance the least? So our earlier question was which of these drive portfolio performance the most? This one is which drives portfolio performance the least? So go ahead and put in your answers. Okay, so I'm going to go ahead and share those results. We were 2/3 on market timing and 1/3 on Warren Buffett. So let's see what the answer is. And the answer is individual fund or security selection. So at the beginning, I told you that asset allocation was the most important and individual fund or security selection is the least. Technically, probably Warren Buffett is not in the universe of options in the studies, but uh, throwing that answer out, it would be individual security selection. So when we're thinking about your portfolio, it's not we don't want to spend all of our time saying, should we use fund A or fund B or stock A or stock B? Really, we want to get that overall asset allocation right, and that's going to make the most difference in your portfolio. Okay, the last pitfall, stock picking. So stock picking is using either a systematic form of analysis, so this is what an investment analyst would do, or at the individual level, some advice you received, or your own emotion or gut to conclude that a particular stock or asset class will make a good investment and therefore should be added to a portfolio or emphasized with a higher allocation. So in mutual funds and ETFs, we would call this active management. And that just means that the fund manager is actively buying and selling stocks or bonds on a daily basis to try to beat some benchmark that they're being compared to. But according to Morningstar, only 1 in 4 active managers beat their benchmark for the period from 2014 to 2023. That is just abysmal. That's an abysmal percentage of performance. So the other thing is that active managers, so their funds cost more. So why would you want to pay more to have worse performance when you could just participate in the market and get whatever the benchmark is providing? So get whatever the market's giving at a low cost. So the bottom line is it's very difficult to beat the overall market. It's you're basically putting yourself against everybody else and trying to be the winner every time, and you just can't do it. It's so much better to just participate in the market. And here's my handful of the pitfalls of stock picking. I won't spend a ton of time on these, but risk of loss, lack of diversification. It's very time consuming to try to pick stocks. It involves emotional decision making. An important thing to note is that a great company does not equate to a great stock. So even though there's a company that you might think, wow, they deliver great service, they have a really good potential for future growth, that doesn't necessarily mean their stock is going to appreciate. So you have to keep those two things separate. There's a reaction lag, and this has to do with the fact that market prices are efficient and everything that you're thinking is already priced in, but you think you're making choices based on unique or unknown information. There's high transaction costs when you're constantly buying and selling and buying and selling. Typically, statistically, it results in underperformance, and then there's the psychological stress of which just raises your anxiety. And then also a typical thing is that you second guess yourself. You decide to make a pick and you're like, "Ooh, was that the right choice? Should I reconsider?" And so it's just a way to be have a very stressful investment experience. So this chart here is just showing that whenever you're trying to beat the market, you're trying to compete. So it's you versus the market. Because when you think about it, if you make a buy or a sell that is in your favor, it's a zero sum game. So if you're the buyer and you buy something at what is a discount, let's say a good price, then the seller is losing because they sold their stock at a discount and they didn't collect the highest value for it. And so because it's a zero sum game in that regard, there's always a loser for every winner. When you try to outwit the market, you're basically saying, I'm better than the entire market. And so you can probably see that it would be a very difficult feat to accomplish. But when you just participate in the market, which is this second diagram, then you're just saying, "Hey, I want to play. The S&P 500 typically does this, the small cap market does this, international does this, and I just want to participate in that." So that's really the way to go. Okay, so that's the end of Julie talking and talking. Do we have any questions? Can type those in the Q&A. You can raise your hand. If you go to the 3 dots for more, and then you choose the reactions, there will be an option for you to raise your hand. You can raise your hand, and I can call on you, and you can ask your question out loud or just type them in verbally. I have one question that we'll start with, and it is, what does REIT stand for? And thank you for asking that because it's really easy for me sometimes to use acronyms or industry jargon that I know what it means, and it doesn't occur to me that not everybody knows that. So REIT stands for Real Estate Investment Trust. And so it's just a way to invest in real estate in a very diversified way. So instead of buying a single rental home, you're investing in a fund, and it might be a mutual fund or it might be an exchange traded fund or it might be a private REIT, but in any of those cases, you're investing in a diversified portfolio of real estate that might include shopping malls and hospitals and schools and commercial buildings and different things so that your investment is spread across a wider range of investments. Any other questions? Okay, well, if you have any other questions, feel free to put those in, but I'll go ahead and move to our next webinar will be on Friday, August 9th at 11 o'clock. This one was at 11:30, but typically these are going to be at 11 o'clock. It will be on the difference between mutual funds and ETFs, which stands for exchange traded funds. So we'll be going over the differences and the benefits, the pros and cons on those. And then here is our list of other upcoming webinars. So after mutual funds and ETFs, we'll be going over why we use dimensional funds, a little bit of a deeper dive into their investment philosophy and why we use their funds. On 9/13, Angela will be hosting the webinar and it will be on navigating the Schwab website. So if anybody is having any challenges with the website, she's going to walk you through everything. On 9/27, avoiding financial scams. On 10/11, interest rates and investing. And then on 10/25, understanding inflation. And as always, if the topic is interesting, but you can't attend the live session, just go ahead and register and we'll send you the replay, the recording, so that you can watch it when it's convenient for you. All right, so that's all I have, unless we have any other questions. Hope to see you in a couple of weeks. Let's see, is it 2 weeks? Anyway, generally 2 weeks, but on August 9th. So have a great weekend, and I will see you soon.